Hello, good evening. Hello. Today is Wednesday, and I think I had put down I was gonna go live about an hour ago, but I guess better late than never. So tonight, and then probably tomorrow, I'm gonna follow up with my third one. I'm doing a little bit of financial and wealth building education for most of us who probably don't have a lot of expertise in this area. So anyway, so one of the things that I am now doing is I am serving as a financial advisor, most in helping people to plan for a tax-free retirement, as well as just building generational wealth and leaving a legacy for their family. And so I think it was Monday when I went live, I talk about 3 different buckets in which you need to be placing some of your savings money. So one of them is a taxable bucket. Well, why would I do that? Well, because you do need to have some easy access to emergency fund money. So the best way for you to do that is just a good old-fashioned savings account or a CD or something like that. Granted, it's not going to earn you a lot of interest, but that's okay. You just need about 3 to 6 months of emergency money in that fund, and then all the rest of your savings can go towards other forms of building wealth for your retirement or for any other means that you might want. Okay. All right. So then, I guess I am doing just a little bit of a review. So I told you that it was really important that you want to allocate all of your monies into the appropriate buckets in the right amounts so that when you reach retirement, all your streams of income are tax-free. And yes, that is a possibility. Okay, so anyway, so again, just as a review, so if you're going to be putting some monies into your taxable buckets, these are your money markets, your CDs, your mutual funds, your stocks, your bonds, okay? All right, and so I'm not going to go over all of that because I did go over all of that on Monday. But now what I want to talk to you about is where most Americans are putting our retirement savings into what would be considered tax-deferred accounts, which really are tax-invested accounts. So these are your 401ks, your IRAs, your 403bs, your 457s, your Simples, Keos, and SEPs. Now, is it a bad idea to save retirement monies there? No, of course not. It's not a bad idea. It's just that you don't want to put all of your money there or a large majority of it there, and I'll tell you why. Okay, so I'll be honest, in most situations, we kind of feel like this is the very best way for us to plan for retirement. So, every time we contribute to our 401k, we get a tax deduction. And so we're putting that money into that account, but we haven't paid taxes on it yet, right? And what we're forgetting is that down the road, when we finally reach, 65, 67, 70, when we begin to take distributions from that account, we are now going to be paying taxes on that money that we are receiving. It is taxed like normal income. However, it will be taxed at whatever the tax rate is then. So if you're 30 years old now and you're not going to retire for another 35 years, do you think that the monies that you would receive as income when you're 65 are going to be at a higher tax rate or a lower tax rate than now? Of course, taxes are raised every year. And so one of the things that we don't realize is that we are really setting ourselves up to go broke slowly and not have nearly as much money in retirement as we originally thought. Not only that, we haven't even considered inflation. So every year inflation raises about 3 to 3.5% each year, okay? So whatever monies that you are putting into savings, if you're not making at least 3 to 3.5% every year, then you are slowly losing money. You are slowly going broke. Okay, so let me tell you why it's not a good idea to put all or most of your retirement savings into a tax-deferred account such as a 401k. I'll tell you why. Are you ready? Okay, because number one, when you begin taking distributions later in retirement, you will be paying taxes on the current rate in that year. And not only that, you will, there are going to be deductions, like right now while you're working, there are certain deductions that you are allotted every year. So mortgage deductions. If you still have children that are living under your roof, you get a tax credit for them each year. Your retirement plan contributions, and there's other types of deductions as well. But what I want you to understand is that when you get to retirement years, all of those deductions have gone bye-bye. Your kids are grown, they're no longer living with you, you don't get a tax credit for them. You're no longer making contributions to your retirement plan, you're actually taking monies out, and in most cases, your mortgage is paid for. So at this point, you have very little to any deductions. So not only do you have very little deductions, so these deductions are no longer going to offset your tax bill. And so in retirement, you could very well be paying, you could be in a higher tax bracket in retirement and making less money. That kind of sucks, doesn't it? Yep. Okay, so am I saying that you shouldn't have a 401k? No, especially if you have an employer that is contributing, then here's what I recommend. You should definitely contribute at the same rate that your employer is contributing, but not a penny more and not a penny less. So if your employer is contributing 3% every year, then you should contribute 3% if they're doing the matching thing. If your employer isn't contributing anything, I would honestly probably tell you to stop funding that particular account, because you are going to be paying crazy dollars in taxes on it when you finally take distributions later on. But there is something that most of us don't know about, and we don't understand the power of it. And this is how the rich people in our country get rich. This is how banks and large corporations make most of their money. And what is it through? It is, hold on, you ready? Are you ready? Are you ready? Are you ready? Are you ready? Would you like to know what it is? Would you like to know what it is? I didn't know if I could create just a little bit of excitement. Are you ready? It is called an indexed universal life insurance plan. It's a life insurance retirement plan. Now, just because I said life insurance, don't tune me out. Wait till you hear all the details to see if it is something that you would want to do. Okay, so this is going to be what we call our tax-free bucket. Okay? All right, so large corporations have been using, this is how they tax shelter their monies all the time, okay? And not only that, you're going, well, I don't need more life insurance. That's okay. You don't even have to use it for life insurance. We have a brand, if you don't have the brand new type of life insurance, which gives you living benefits, then you are missing out. So we have a type of life insurance that can help you to build cash in the account, accumulate it at a very fast rate. And then when you decide that you're going to take it out later in life, or if you decide to use it for whatever, you are not going to be paying any taxes on those dollars whatsoever. None, zilch, nada. This is called bank-owned life insurance or company-owned life insurance. This is how the rich in our country get richer and richer and richer. Do you remember the man who went to prison or was accused of killing his wife? The initials of his name starts with orange juice. Do you know how he still had hundreds and thousands and thousands and thousands and thousands of dollars after he got out of prison? All of his monies were tied up in universal indexed life insurance policies. All that cash was accumulating in those accounts, and the government couldn't touch it. They can't tax it, they can't take it away from him, and most of us know nothing about this. So here's what I want you to consider. If you go, well, you know what, I already have enough life insurance, that's fine. You don't even have to use it for that, because now the new type of life insurance that we have gives you living benefits. So you could have a critical injury, a chronic illness, a critical illness, or you could need long-term care. So most Americans are living longer and longer and longer. Many are living into their 80s and into their 90s. And by the time that they reach that age in retirement, in most cases, they are not completely able to take care of themselves, right? And so many of them are needing long-term care. So if you get to that stage in your life and you need to use those monies for your long-term care, you can actually take monies out against the death benefit and use it for your long-term care. So in other words, you would get a double whammy so you would get to use the money for long-term care, and then the cash accumulation, you could be taking it as distributions during your retirement years and pay absolutely no taxes on it whatsoever. So I know that was just like a really kind of breakdown of it, but I guess what I want to share with you is this, that I think I lost my place. Hang on a second. Yeah, okay. So in your retirement years, you need to realize how much money you can be receiving as retirement dividends or distributions and not pay taxes on them. Okay, so right now, if you were to retire right now, the standard deduction is around $24,000, right? Okay. By the time, let's say, I don't know, 15, 20 years from now, the standard deduction will probably be around $37,000, okay? So let's say that that's how much that you took out of your 401k, which you hadn't paid taxes on yet. No, I'm sorry, let me go back. In other words, you only want to be receiving about $37,000 a year from whatever sources, so that it will offset your individual standard deduction, so that you don't have to pay taxes on that money. But most people can't live on $37,000 a year. So if the rest of your monies has been building cash in a universal indexed product, you can take as much monies as you want out of that bucket and pay absolutely no taxes. This is why you need to talk to me. So in this video, there is a link to my scheduler, or you can just text me below and I can answer some questions for you over the phone. But I am telling you that I really believe that we in Middle America need to become very financially savvy, so that we not only don't end up paying bukus of taxes on our monies in retirement, but also so that our Social Security benefits are not taxed also. And I'm going to be sharing about that a little bit tomorrow. I hope this was beneficial for you. Do me a favor, like, love, and share this on your timeline, and I will finish up a little bit more education tomorrow. Bye.